I know that we've talked a lot about tax-free savings accounts and retirement annuities on this channel, and although these are the best investment vehicles for the long term, some of you might be sitting there thinking, Pieter, I know I need to save for retirement, but what if I just need a place where I can safely store my money, where it will grow above inflation, and where I can have access to it in the next 2 to 5 years for things like a car or a house down payment, or perhaps my child's tertiary education. Introducing RSA Retail Savings Bonds. These okes are often overlooked, but they can be quite powerful when used correctly. So in today's video, we will take a deep dive into what exactly a retail savings bond is, how they exactly work, both the advantages and disadvantages, and at the end I will give you my opinion on when you should consider investing in them, as well as what my best strategy would be when doing so. Alright, so let's make like James and Bond, I guess. So let's quickly look at what exactly a RSA Retail Savings Bond is. These bonds were issued by the SA government in 2004 in order to encourage a better savings habit for its residents. They work very similarly to how a fixed deposit at the bank will work, as in you basically lend your money to the government for a fixed period of time, in this case anything from 2 to 10 years, and then they pay you interest on the amount borrowed. It's basically the reverse of you borrowing money from the bank. So why exactly does the government need to borrow money from us? The government mainly earns income from the tax revenues, but as you all know, they spend way more than what they earn on things like roads, education, SOEs, and, well, in Nkandla. This imbalance of spending more than what they earn forms a gap, and this gap is called the fiscal deficit. And in order to fund this deficit, the government needs to borrow. But they cannot just take our money. They need to provide some form of incentive, and this incentive is to pay us interest on the amount borrowed every single year for an agreed period of time. They also need to make the incentive enticing enough, because as investors, we are always looking for the best deal to grow our money. So the rates on RSA Retail Savings Bonds are typically much higher than most other fixed deposit at banks over long periods of time. And in some cases, they may even beat the average return of property and even shares on the stock market. Wow. Alright, so let's look at how these bonds work. Only South African private individuals can invest in these products, so you have to be a registered South African resident in order to qualify. No companies or trusts may invest in them. You have to invest a minimum of 1,000 Rand, and they also recently scrapped the 5 million Rand limit, so you are not capped on how much you can actually invest in these products. Now, you will have the option to either invest in fixed rate bonds or inflation linked bonds. Before I explain the difference between these two, we first need to look at how exactly the rates on these bonds are calculated. If you look at these two tables, you can see that the rate is continuously changing. Sometimes it moves up and sometimes it moves down. Now, the interest rate of the RSA Retail Savings Bond is derived from the government bond yield curve, and this is reviewed by National Treasury every single month. This yield curve reflects the interest rate over various terms at which government bonds are traded on the Johannesburg Stock Exchange. So basically what this means is that the RSA Retail Savings Bonds interest rates are determined by market forces like supply and demand and internal and external economic factors, basically similar things that influence the share price of a company on the stock market, which we all know by now can move up and down over the short term. Okay, so the main difference between fixed and inflation-linked bonds is that with a fixed rate bond, you invest your lump sum at a fixed rate, which is the prevailing interest rate at the time you start your investment. This rate will remain exactly the same regardless of whether or not the interest rate of the retail savings bonds change in the future. So this is locked and guaranteed throughout the entire investment period. Now, you do have the option to reset your fixed bond rate after 12 months. So if, for example, you took out a 5-year bond at a rate of 8%, but 1 year later the rate increased to 10%, then you can just reset your fixed rate bond to 10%. With an inflation-linked bond, the rate that you would receive will change every 6 months based on the inflation rate of the Consumer Price Index that is published monthly by Statistics South Africa. This means that your investment will always earn inflation-beating returns. There is no option to reinvest any interest payments for these bonds, so the interest earned over that 6-month period will be paid out into your account, and then after that, a new interest rate will be determined by the prevailing inflation rate at that time, and this will be your new inflation-linked bond rate. These payments are made on the 31st of May and the 30th of November every single year. So basically, when the inflation rate goes up, the interest that you'll receive will also go up. And likewise, when inflation goes down, your rate will also go down. Fixed rate bonds typically have higher rates than inflation-linked bonds because of the fact that you need to tie up your money for a fixed period at a fixed rate. The principle is very similar to how normal saving investments works. You will typically earn a higher interest rate on a fixed deposit than what you would have on a normal savings account with your bank. So to summarize, the rates on the fixed rate bonds will change every single month, whereas the rates on inflation-linked bonds will change only every 6 months. Fixed rate bonds offer 2, 3 or 5 year terms, whereas inflation-linked bonds only offer 3, 5 and 10 year terms. You can generally choose to have the interest you earned on your bond to be paid out every 6 months or at the maturity of the bond. If you invest in fixed rate bonds, you are also allowed to have your interest paid out on a monthly basis. Full or partial withdrawals are allowed after a bond has been held for 1 year. However, a penalty will be applied for this. So let's look at a couple of advantages of these products. With a retail savings bond, you know exactly from the outset the amount of interest that you will receive as well as when you will receive it. Retail savings bonds cannot be sold in the market, thus ensuring that your investment is not exposed to any market risk. This makes planning ahead much easier as your returns are guaranteed and predictable. There are no charges, commissions or costs associated with them, which is huge as high fees can easily erode your long-term savings and investment returns. Retail savings bonds typically offer higher interest rates than those from fixed deposits from banks. They also trump the returns from normal savings accounts, so they are a great option for your medium savings goals, like buying a car or a house, or perhaps funding your children's tertiary education in about 5 years. You can restart your fixed rate bond, so if the rates were to go up higher, you have the option to restart your investment at the higher rate in any of the available terms. There will be no penalties or costs associated with this move. This is a really cool feature and not something that banks will offer on their fixed deposits. And then also to just touch on a couple of disadvantages. There is a small risk that the government would be unable to pay you back your principal amount and the earned interest. This is what we call they default on their payments. For example, Argentina defaulted on its debt in 2001. However, South Africa's debt is in a much better shape, believe it or not, and the chances of this happening are very slim, but still the risk does exist. As an investor, you need to ensure that your investments are at least keeping up with the annual price increases, aka inflation, which is currently hovering around 4.5%. Now, if you fixed your retail bond at say 8% for 5 years and we hit hyperinflation, where the inflation rate goes completely haywire and shoots past 10%, then you are effectively losing money as the purchasing power of your bond investment will drop. Again, this is unlikely to happen, but still not impossible. And then one of the biggest disadvantages of retail savings bonds and just fixed deposits in general is that you have no access to your funds over the entire term. If you do want to make an early withdrawal, you will have to pay a penalty. But Pieter, are retail savings bonds really that safe? Well, it depends on what you mean by safe. No investment is truly safe, but in my opinion, they are one of the safest investment options available in South Africa. It is way safer than keeping your money under your mattress because, as we've established earlier, inflation is public enemy number one when it comes to investments. If your money is kept as cash in a jar at home, then you are effectively losing on average 4.5% of your purchasing power per year. And even by investing it in a normal savings account at the bank, it will still cause your money to lose value as their interest rate offerings are typically below the average inflation rate. So if we talk about safety and risks, then the value of your money is at a much higher risk sitting in cash than in government bonds because of the eroding effect of inflation. But yeah, I know. The main concern that you may have is whether or not our government will go completely off the rails and default on its debt. While this is not impossible, I do not foresee that they will default on their local debt obligations, especially to its residents in the form of retail savings bonds. In a worst case scenario, they would probably default on their foreign US dollar debt, but on their local debt, the Reserve Bank will most certainly step in, as they have done to prevent systemic collapse in the past, and thus they will just print enough money to allow the government to repay its local debt holders. Now, while the rand's value will then effectively also fall, you will at least still get back your principal and interest amount investment and will not be left completely dry and empty-handed. Also, our national treasury is a trusted government institution, and because of this, many local and international institutions invest their money in our government bonds on the secondary market, mostly in the form of pension and hedge funds. This basically just shows the confidence that both local and foreign institutions have in the ability of National Treasury to honor the payments on government bonds, which essentially also include RSA Retail Savings Bonds. Guys, if you found this video helpful so far, then I would really appreciate it if you can just drop kick that like button for the YouTube algorithm so that it can spread to more people. Kia ora. Okay, so who should then consider investing in these bonds? Well, seeing that the terms on these bonds range anywhere from 2 to 10 years, I would consider these as medium-term investments. So if you know that you will need to save for something big in the future, like a car or a house down payment, or perhaps your child's tertiary education, then these will definitely be a great option. They offer a guaranteed return on your capital as well as really good interest, which is something that the stock market simply cannot do. Yes, you may get better returns when investing in shares, but as we have seen, the stock market can just crash anytime. And if this is money that you know that you will need for something really important, you do not want to be in the difficult position where you are forced to sell off your share investments just after a market crash, as then you will realize your losses, and this can be detrimental depending on your situation. Shares are great for long-term investments where you can weather out a market storm and where you have the time to wait it out until the markets recover before you sell off your holdings. But you will take a gamble in the short and medium term on share and property investments. Also, the current rate on the 5-year fixed bond is really good, sitting at 9.25%, which is very competitive and similar to what share investments will typically return on average over the long run. So now is actually a very good time to benefit from this excellent rate. Retail savings bonds are also great for those who are retired, as again, they preserve your capital, ensure that it keeps up with inflation, and that you can receive monthly interest payments, which is great seeing that you are not earning a salary anymore and that you are now dependent on your investment returns. The interest payments are constant and predictable, so it makes planning ahead for your retirement much easier. As an example, If you invest 5 million Rand of your retirement funds in a 5-year fixed retail savings bond, you will earn a lekker monthly interest payment of 38,542 Rand. On this graph, you can see that these products are very popular amongst retirees because of these exact reasons. Okay, now it used to be that you can only put in a lump sum once into a specific bond. You were not able to top up an existing investment. So if you wanted to invest again, you would need to invest in a new bond that will have its own interest rate and maturity date. You will also need to fill in an application every single time you invest in a new bond. This is going to make your life very tedious and complicated, especially if you want to invest every single month, as then you will just end up with a gajillion different bond investments that can make it very difficult to keep track of. There is a really cool website that can help you with this called the Bond Club, and I will link to it down in the description if you want to check it out. Now, the government did recently announce that they will introduce a new type of retail bond investment called a Retail Savings Top-Up Bond, where you can now actually top up your investment every single month. This is great news, as this will take away the burden of having multiple bond investments at one time. They are only going to introduce this on the 1st of April 2022, so there's not a lot of info on the rates and investment periods yet, but I will probably make another video once that is released. In terms of deciding between a fixed or inflation-linked rate bond, given that the interest rates on fixed rate bonds are way higher at the moment and that you can actually restart your bond investment after 12 months, it is a no-brainer for me to go for the fixed rate bonds. Yes, with inflation-linked bonds, your investments should in theory beat inflation, and should inflation go completely haywire, this may be a better option. But even so, if this should happen, the fixed rate bond rates will likely also go up. So then you can just restart your investment at this higher rate. No problem. But if you want to rather play it safe, then simply go 50-50, thereby capitalizing on the benefit of both products. So to conclude, I believe that the RSA Retail Savings Bonds are excellent products for investments over the medium term as well as during retirement. Not only do they have a very low barrier of entry and no fees attached to them, but they have also improved quite a lot since they were introduced in 2004, as many of their limitations were removed during the past couple of years, including the cap on the amount that can be invested, the option to restart the fixed term bonds, and the option to receive monthly interest payments even if you are younger than 60 years old. They are currently offering extremely competitive rates, and we, as investors, should strongly consider them if they fit into our overall investment strategy. What do you think? Will you consider investing in them? Let me know down in the comments. Okay, bye.